Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Hey guys, welcome to our Tuesday Night Podcast. We are live. We have a special treat for you. We have Melody Wright in the house, and this is going to be a great show. We just published a video with Melody on Saturday on our channel, and because so many of you commented, were just so interested in what she had to say, we decided that we would bring her on in our live stream so that you could ask questions directly. Because a lot of people are really wondering what's going on, the frozen housing market at this point. Our interview that we published on Saturday, Melody and I both go back to before the great financial crisis in this industry. And, a lot of people are saying that we would never have anything like that again, never have another fallout, that the housing market is sound, and for a couple of reasons that we'll talk about tonight. One being there's this storyline where everyone has so much equity in their home, and we're going to try and unfold that a little bit, because a lot of people have taken out home equity lines of credit. They've sucked a lot of the equity out in their house because of the cheap interest rates. But not only that, but we're going to kind of dive into, why things are kind of shaky right now for the amount of debt that America is in. And a lot of people, they got in trouble, got themselves in high credit card debt and bought cars, and their home prices, a lot of them in the last 3 years, they paid top dollar for their houses, and they weren't expecting things like insurance and tax increases and things like that. So we're going to break it down for you tonight. Guys, Melissa, let you welcome Melody, but thanks so much for another Tuesday night.
Another Tuesday night. Thank you so much. And just as Todd said, so much going on. Debt being one of the large ones, the interest rates. There's so much to talk about. Melody, what a treat having you with us again this evening. So thank you. And please tell us a little bit about yourself.
Thank you so much for having me. So quickly, I fell into mortgage by accident in 2006. That's how most people fall into the mortgage industry, and sort of right at the most opportune time. And that's a lot of sarcasm. And from there, things just kind of went crazy as we tried to survive, working a lot of different, trying to figure out what we would do. Would we sell our company? Because we were a top 5 originator and servicer. And a big part of our origination arm had been focused on non-traditional products. And I say that instead of subprime, because I think a lot of people misunderstand what subprime really was, and some of the investor behavior that drove a lot of, or at least sort of started the fire of that crisis. So helped manage that. Ultimately, we got TARP funds and tried to survive, but we had to go into bankruptcy. And I kind of handled that for the company. And then once I was done, I got asked to sort of take over the default, because they had gotten into so much trouble for what was called robo-signing back in the day. And that was signing affidavits where they didn't have personal knowledge of the facts and figures. And so the big servicing companies, and that's the people that take your payments, got into a lot of trouble. And part of that was essentially we had to figure out how to manage our default process, because we were in bankruptcy, and Fannie Mae and Freddie Mac were threatening to take away all of our servicing. And this is a lot of complicated stuff, but suffice it to say, we had to figure out how to manage our default. And so I got to witness firsthand how kind of Wall Street and investors came in 2012 and 2013 and started buying up a lot of these homes that were at auction. And what they did with those is turn them into long-term rental. After the bankruptcy, I went out to other non-bank originators and servicers, trying to really help them sort of comply with all the new regulations, as well as find operational efficiencies. And that, of course, led me to technology, because in our industry, the core technologies were built in 1968 and 1972, the two biggest ones. You can walk around banks and still see blue and black screens, and that is not a joke. So I started trying to build a lot of that technology. Um, but went off to fintech companies and did it there as opposed to being inside the shops, because I really couldn't get the kind of change that I wanted, that I thought the industry needed. So tried to do it from the outside. And while I was doing that over the past 4 or 5 years, I also kind of helped manage. I had a little staff augmentation team of little loan processors. It was a weird part of my job. Had to manage that, as well as I started diving into the macro, because everyone around me wanted to know when the music would stop. And so that's kind of how I ended up putting together an article for Housing Wire in January about what I'm calling the inventory myth. And let me just be clear that we definitely we have a shortage of affordable homes, but my argument is that we don't have a shortage of affordable a shortage of housing stock, definitely a shortage of affordable housing stock. But from there, went out on the road to make sure that I wasn't crazy, and went out to a whole bunch of cities to kind of see what was going on, boots on the ground, and saw a lot of this new build construction that had gone just completely gangbusters. And so for short-term rental, long-term rental, something called built for rent, as well as all the vacant homes that already really existed, about 15 million of them out there. So that was a lot of words. I'll stop and you guys can tell me.
You said 15 million vacant homes right now?
That's correct.
New builds?
It's not new builds. So it's more, those are the vacant homes that they're not abandoned, but these are the homes that people are not living in full time. So a lot of them are second homes. There's some really good breakdowns of that number. Like Wolf Richter has done a number about 6.6 million, he says, are really the ones we think are going to come back onto the market because of boomers selling and offloading. There was just an article in the Real Deal yesterday, and they state 5 million. So it's really kind of how you look at that overall number. But it is in the millions, anywhere between 6 and 15 million of vacant homes that, essentially they're mainly second homes that I believe that once, these property insurance and tax bills kind of come in the mail, a lot of people that are carrying them simply won't be able to do it anymore. Or they're going to say to themselves, this is the ideal time to offload this property so I can take my money and put it into a money market fund or buy, treasuries. So that is something we expect to kind of see unfolding over the next several years.
Yeah. Well, I want to take a look at an article, and we're going to deep dive into why. And, when people hear you say, I've said it too, that we could see something bigger than the great financial crisis in the housing market, they don't really understand why. And we're going to dive into that about,
Sure.
The credit worthiness, or how sort of vulnerable our homeowners are that that are experiencing this high cost of living and house repairs and just making ends meet. And then, like you said, they're getting insurance bills where in some cases they're quadrupling.
That's right.
And the tax bills are going up. And I've talked to some people, their payments have gone up in the last couple of years, hundreds and sometimes $500-$600 a month than what they signed up for when they thought they had a fixed rate mortgage. But I want to take a look at this because I want to get your opinion, and I'm sure you've heard about it. But the National Mortgage Professional.com, and this is really no secret here now, industry associations raise alarm on soaring mortgage rates to the Federal Reserve. Now, these guys, they're going to tell Jay Powell and company what he should be doing. They're going to say, look, this is amazing, right? Urgent plea. They're begging here for clarity on rate hikes and mortgage-backed security sell-offs amidst fears of an economic downturn and the housing market instability. Now, let's forget about the fact that consumers are having a hard time buying groceries. We have three major associations here. They're going to beg Jay Powell for their own industry good, right? Leading industry associations, including the
Right.
Mortgage Bankers Association, National
Right.
Association of Realtors, and National Association of Home Builders, are using their collective voices, to convince the Federal Reserve Open Market Committee to provide clarity. Look, we want to know, we want clarity
I
on
feel
rate
like he's
hikes
been
and
clear.
mortgage-backed
Yeah.
securities. They are urging the Fed to communicate two pivotal points to the market: no further contemplation of rate hikes and a hold on the sell-off of mortgage-backed security holdings until the housing finance market stabilizes. Melody, what do you think about this? Because they're saying that this is causing a disruption in the real estate sector. Now, again, I mean, forget the fact that there's no affordable housing in America. Forget the fact that people are, there's so much remorse, right, on the ones that have bought a house. And here, what do you think about the association crying out to Jay Powell and company?
It's absolutely ridiculous. I mean, I couldn't believe it when I saw it. And I was, laughing, and in many ways, like, I think they understand they're about to be on the hook for encouraging everybody to date the rate. And,
Mm.
everyone you talk to said, oh, don't worry, you'll be able to refi. I mean, it's almost as if they didn't get the irony, even those that had seen The Big Short, where, you know, but he said I'd always be able to refi. I mean, we know that line. Everybody knows that line, but that's exactly what everybody's been going out there and saying. And so I think that they're starting to realize, well, there's a liability here in some ways, I think. I know that's not something that's ever really happened
Uh-oh, there she
Oh,
goes.
to be
We'll get her
able
back
to
here.
kind of
There she's back.
refinance out of this. And if you take the buy downs that the builders are doing, that's even more concerning, right? Because those are just like arms, except they're not classified as arms. But a 3-2-1 buy down is the same thing. Basically, your rate is going to increase over 3 years. And the first of those are starting to reset just now, because the builders started in earnest in July of 2022. So, I think this is comical. They don't want to take any responsibility for why, home prices went so crazy, how they participated in the FOMO, how every single news article that, some of those agencies have sponsored have been about low inventory, driving that FOMO, driving those home price increases. Because the average mortgage rate since 1971 is in the 7% range, but home prices, increasing in this short span of time is unprecedented. So it's a joke.
Okay. Explain, Melody, excuse me, explain how, when we look at today, the mortgage-backed securities and the credit profile, right, the risk. Explain how today the only difference between right now in 2006, right, 2005, 2006, 2007, when we're looking at, what, explain the similarities of how we're at the same point, but only the government is backing these, right, these mortgages now more than they ever have. Can you kind of break that down?
Sure. Yeah. So, what the mortgage industry was comprised of prior to sort of all the regulators getting involved in the AG settlements, the consent orders, et cetera. I mean, there was a private market back then where people are, privately originated. A bank could originate a loan and they would keep that loan on their books. They'd securitize it, but they'd keep the underlying interest. Well, in today's market, 95% of the market is government backed, meaning it's either backed by Fannie Mae or Freddie Mac or by FHA through Ginnie Mae. Now with Ginnie Mae, that's supposed to be a fully insured product where if something goes wrong with that loan, you're going to get fully reimbursed. We'll park that for a minute. That's never what happens. On Fannie Mae and Freddie Mac, they say it's backed by the full faith and credit of the government, but what that is essentially they would pay the servicer's expenses. So a little bit differently, but put it this way, most of your banks hold none of these notes or the collateral. They might own like an underlying security, or they might own a servicing right or the right to service that loan to get a very small fee. But they don't own these notes. And so 95% of these notes are owned by Fannie and Freddie, or, essentially securitized through these agencies. Now, that's different. And what's flip flop is that where that subprime or non prime was before, the government has now doubled its FHA VA lending since 2009. And now a lot of people say to me sometimes, well, there's nothing wrong with trying to get a first time home buyer into a home. There's nothing wrong with trying to get a veteran into a home. 100%. I totally agree with that. If it's logical and if the ability to repay has been actually checked. But what happens a lot of times, and what's happened since 2009, is everybody has a vested interest to keep these engines going. So they kind of loosen the standards. And the idea that it's supposed to be government backed, supposed to make it be less risky. So I think many people are shocked. There was some good Twitter, like a video that went around Twitter, and some post about looking at some of the underlying securities that were, AAA rated or whatever, but looking at those credit scores and seeing they were in the 600s or something, and people were surprised. Now, I wasn't surprised because that's what Ginnie Mae is. But I can tell you that how low some of these scores are has been a bit shocking, as well as the rate of change on these delinquencies is really, it's growing at a very fast pace. And so what's different is that now most of this is government backed. You have a 5% kind of private market. That's where you'll see your what's called non-QM or your DSCR, debt service coverage ratio loans. But it's kind of flip-flopped from where the private was a bigger exposure back then. It's now that the government is actually more exposed here. And there's a lot of ways the government's going to transfer that risk right on back to the lenders. But I'll stop there and see if you want me, which direction you want to go.
No, but what you're saying is that these are risky loans. It's the same type of risk that we had back in the '08 great financial crisis. The only difference is the government's backing more of it versus the secondary market,
That's
right?
correct.
So what happens is, when we look at it, and I know that, so, you have with Fannie and Freddie, they're government sponsored enterprises. So it's a quasi kind of government enterprise here. It's regulated by the government. These are still backed in some way by the federal government, right? And so a lot of these, they let upon origination, I think there are some circumstances where you could have a debt to income ratio of like 50%, right?
Yes. Yep.
So,
yes.
and
Much higher. Yeah.
Yeah. So, and the problem with that is that when they have an increase, or they need repairs to a home, they get in there 5-7 years later, the home needs major repairs, or their insurance goes up, right? Or they get canceled, and then the bank comes in and puts a very high, price policy on their protecting their asset at that point. And when property taxes are rising, that's really dinging their debt to income ratio. And then we're not even in this number. Have they been considering student debt? Have they been considering, medical bills and things like that?
Not the same way that they used to. And so for the student debt specifically, they just look at the payment and not the actual outstanding balance. So that $250 that they're paying, not that they really should be paying $1,000 a month. So it's very different.
Yeah. So what do you think is going to happen here? And so we now have the Biden, I think it was, I don't know, I guess it was earlier this year. There's been so much work out, right? I mean, so now the government has this massive responsibility or obligation with all of these trillions of dollars in mortgage debt, right? And, so now they've taken all this risk. they've already worked, they have performed so many workouts since COVID. I mean, it's really a lot, right? I mean,
Yeah.
over 312,000 homeowners were saved a foreclosure in the first quarter of this year because of, the American Rescue Act. Over 1 million households have taken advantage of loan modifications of some type. Now they're taking up to 30% of the loan balance for FHA and VA, which is no surprise, right? If they hold this debt, they're casting that on the back. They're basically removing it, 30% of their principal balance if they're struggling in default, and they're casting that into a second mortgage on the back end with zero interest rate. And, and then to top it all off, they can recast that balance to now a 40-year mortgage. But at what point is that not enough?
It's not enough already. I mean, I'm already seeing a lot of borrowers. So not even kind of call into contact. They know they can't afford it. I've actually seen in some of my books that I still oversee borrowers that should have never gotten a loan in 2019. And they've just been able to, because it was right at the cusp of, right when COVID hit, they were able to get that first forbearance and they've made it this far, but everything is running out. Like as you said, Todd, all of that government workouts, many of them have used all of those already. And so everybody keeps saying the government will come in and help. But just like we saw last time, and everybody should go back and look at the statistics on, how many people actually successfully were able to do a workout. Many people will not, even with a 40-year mod, they will not be able to afford it with those tax increases, with the increases to insurance, and just the cost to keep a home, like you say, and especially these people that did things like waive inspections or things like that. Like we won't even go there, but so there's not enough workouts right now. Would the government come in with new programs? 100%, that's going to happen. But just like last time, it's not going to save everyone. And the other thing that everyone should be thinking about is that we're already seeing, so the Philly Fed did a great paper on non-owner occupancy fraud. And so what I'm hearing, and I hate to even say this, but a lot of the FHA and VA borrowers, especially in places like Hawaii, were using those loan programs to buy short-term rentals, and they signed those occupancy affidavits. But the Philly Fed, kind of looked at, when you're looking at loans that are bought, for speculation, for investment, that 30% of that activity is fraud, and that's been persisting since the last crisis. Nothing slowed down, and I can guarantee you, and we're already seeing evidence of it. It just sped up as that boom happened, and everybody was so busy and nobody was sleeping. So there's going to be a ton of mistakes that just happened, but there's also going to be a ton of fraud, and
everybody was getting paid. Everybody was getting paid.
That's right.
That's
right.
So, I think about the government workouts and I say, okay, well, what will be next? Because I know that when someone's not paying their mortgage payment for a couple of years, right? And I mean, that could be the case. I mean, it was up to $50,000 per household here in Maryland, right?
Right.
The last, in July of 2021, when they gave that, when they, ended the mortgage moratorium, which basically jammed down the bank's throat that, hey, or the investor's throat that basically, we're going to modify these loans, where they had all kinds of weird things, like they would take a massive payment would be required in 4 months or 6 months. They're like, well, if they can't make a mortgage payment, what makes you think in 4 months they're going to be able to make 4 mortgage payments? So then they started throwing them on the back end. But, we both know, have gone through this before. We know that when someone stops paying their mortgage payment, there's other things that they're neglecting with the house. They start thinking about the mindset of, hey, I'm going to save as much as I can because we're going to lose this place.
Right.
A lot of them do, right? They go, we're going to lose this place. We may as well just save our money because we're going to need it for rent. And, we're going to need it to move out. And, they don't fix things that break. So for the government, we like to say, well, the government will do more bailouts. But the fact of the matter is the bailout going to send an inspector around to everyone's house Number one, to make sure that they're still living there. Number two, to make sure that it's a safe place to stay, that it's not leaking inside. I mean, at what point do they have to protect, or is their responsibility to protect their asset, right? Because that in itself, the house is deteriorating. And are they going to then provide them with interest-free loans or second mortgages to fix their heating and air system, to put a new roof on their house? I mean, eventually, it's got to catch up.
Yeah. And this is the funny thing nobody knows. I was just talking about this with some other veterans. And I said, I never wanted to hear about mold again, like for my entire life, because the agencies have these mold forms that you have to fill out, and you'll get a repurchase if you don't. And there are actual workouts you cannot do if there's mold in the home. Like you can't do like a deed in lieu. And so I think a lot of people think it all sounds good, right? We all have this narrative about the government coming in to bail out, but no, actually the government didn't really bail out the homeowners. Essentially what they did is they made the banks, the servicers, pay all the bills, pay the taxes, pay the insurance. Then they turned around and made them repurchase the loan. And then if they couldn't do that, then that's when they started facilitating the auctions, once those things were taken back into real estate owned. So, like a government bailout, just ask your friends who were foreclosed on how much that worked out for them. I mean, there's a lot of them around. And ultimately, what I think I talked to you a little bit about, Todd, is I'm most concerned with the all cash sales that we saw between late 20 and 20, still today, 23, somewhere between 20 to 30%, and in some markets, 50% all cash sales that we know were actually probably loans that were from a wealth management group. They could have been a cash out refi of another property. They could have been loans taken out on your equity or crypto assets. So it wasn't just all cash, because we don't use cash that way in our hyper financialized world. Nobody would. So these won't be on a bank's balance sheet. And what that means is the bank's not responsible because of that securitization market we were talking about. The bank, when that thing, they are servicing it or they hold it, they have to pay the investors, they have to pay the county, they have to fix those code violations. But to your point, they can't come inside the house very often. So even for those, they may do an inspection every 30 days. They're not doing a full house inspection. They can't get into the property. And there's all kinds of, if they try, you can imagine, what kind of havoc that is from a you can't come into somebody's home, put it that way, without being invited. It becomes a legal nightmare. Yeah.
We're talking about this, right? And I mean, obviously, this is known. There's nothing special about, what you're saying or what I'm saying. I mean, right. This is known by the Fed. This is known by, a lot of people, right? Our economists. With that in mind, and we look at mortgage interest rates that are, 8 and 9%. I mean, we're seeing 9%, 30-year fixed mortgage rates, 9% right now. I had a lender call me yesterday and said, "Oh my gosh, we got a break. We got, mortgage rates went down." I'm looking at it today. I'm like, unless you're buying points, you're looking at 8%. You're looking at 8%, 30. If you have any kind of, credit issues, if you're a 640, which they're saying most FHA loans are in the 640s,
yeah.
You could be looking at a 9% mortgage, depending on how much you're putting down. So when we know these things and we know the risk that's out there, and we see the housing market with all the cheerleaders that are, they're holding on to this hope. What am I missing here? I mean, when you're looking at this data, do you think we're all of a sudden going to see 5 and 6% mortgage rates anytime soon?
I mean, if we do, it's because, the Fed had to cut because we're in serious economic trouble. Like, that's the only reason we'd see those reduced rates. And then and typically that's going to be because of job losses and all of those types of things. So, I can't really see that happening. And at the same time, if it does, it's because we are in significant distress and nobody is going to be trying to buy a home. They might try to refi, but it's going to take even a lot more than that for it to be a significant refinance population. And one thing
But
that I say is, unless the UFOs come and give us all jobs and pay raises, honestly, pay raises, I really don't know how anybody's going to afford these homes.
we would have to see hyperinflation.
Right.
I mean, like we haven't even seen, right? We would have to see
Right.
massive for these home prices to make any sense at all. I mean, investors have backed out of the market, right? Because they're waiting, they're waiting on the sidelines, hoping for a correction, right? A crash, because they're like, the numbers don't make sense. When you look at Canada, you look at the UK, you look at China, I mean, you look at everywhere. I mean, the housing market is so out of whack globally. We're a global economy now. But when you look at it and you say, okay, for these home prices to make sense, I mean, when you look at what people need to make, you have to have dual income to buy a house.
Yes.
When you look at, unless you are the rare exception, when you look at the price of the homes, unless we have hyperinflation, how can they go up? When you hear all these people saying, well, home prices always go up, buy now or you'll be sorry. It would be a catastrophe in itself, in my opinion, to see the house prices go any higher, because we would have to have hyperinflation in a time when our businesses are struggling the most, right? I mean, our number one employer in America are small business owners, right? They are struggling the most. Bankruptcies are up. I've got a chart to show that. Bankruptcies are up. Their credit lines have dried up. So for these people to make enough money to be able to finance a house, it doesn't make sense, right? But think about this. In my opinion, the only way that we're going to see 5% or 6% mortgages is if the government starts buying mortgage-backed securities. Because why would the secondary market, if investors are looking, they're smart, and they're looking at our situation and they're saying, man, I tell you what, all the loans that the government has written here are backed. Man, they've had to print a lot of money to save them. I'm not going to get that same protection in the secondary market, right? I mean, they're going to pass that risk right through to me buying these mortgages. I'm going to say, no, thank you. I'd say, wait a minute, guys, how many have you rescued in the last 3? You've rescued over 1 million homeowners from foreclosure. And now you want me to invest in that at 6%? That's it. I mean, am I missing something?
No, and that was the funniest part of the letter to me. It's like, okay, the Fed hasn't even said anything about selling those MBS and has been very careful about not saying much, right? And so for them to bring that up, that is for them to bring it up when nobody's talking about it, tells you how scared and desperate they are, because there is no market for that. There's not going to be a market for this stuff. If the Fed tries to sell it, who's going to buy it? I mean,
well, they know what's going on, though.
That's already have enough.
I mean, that's the scary part, is these associations know it's happening. And the Fed may not be talking about it, but these associations know that they're passing this risk on. They're trying to pass these mortgage-backed securities on to these investors. I mean, it's crazy. Let's take some questions. Mm-hmm. I know a lot of people, let's kind of start at the top, because we promised people that posted first that we would answer them. So let's just kind of go. I know a lot of people have questions for Melody.
Sure. This is more of a statement, but talking about what they're seeing, where they're living, patiently waiting on the sidelines to purchase a single family home in Miami-Dade County.
Yeah. And
then we've got Todd Sachs for NAR president.
Oh yeah. I'm sure they're all happy with me right now.
Went and drove new construction areas in Dallas-Fort Worth this past weekend. Builders are definitely not listing all their inventory. So many built homes that are empty. It's a crazy game they are playing.
Talk about that, Melody. What is shadow inventory?
So it's a lot of things, but specifically with the new builds. Something very interesting everybody needs to know is that, the Fed tracks our permits, right? So permits filed, construction started, construction completed, except they don't actually track cancellations. And so they're not showing how much is actually fully completed because they don't consider it in that completed inventory if it was previously sold. Okay. So anyway, let's put it this way. Out there in all these cities where I have visited, I've gone to the new build sites and I've done little tests of looking up on realtor.com, looking up on Zillow or Redfin for these sites. Where are they? Where are these homes listed for sale? What you'll have a lot of times in the builder site will be one home listed for sale, and there's a whole subdivision of 200. If it's a built for rent site, very similarly, you might find on one of the listing sites one listed for rental, but not the whole subdivision. And so we don't have any understanding of how much inventory there is out there because there's all kinds of funny things. Like if you're a builder, maybe you were building it because someone ordered it and said, "Hey, I want you to build this for me," and then they canceled it, and then you decided that's going to be kind of a spec home. Until you file your certificate of occupancy, that's not really a completed home in many builders' minds. So there's all kinds of, I'm not going to say people are lying. I'm just saying they're taking advantage of certain known loopholes in all of this, kind of artificially suppressing inventory. And so that's kind of shadow inventory on the new build side.
So don't you think
I won't
that
go through
is
the whole thing unless you want me to.
no, I mean, I think that everybody gets it. I appreciate that explanation. I mean, so you would think if we're trying to report, I mean, why is it that you and I are talking about this and, the National Association of Realtors or the National Home Builders Association or the, Mortgage Bankers Association? I mean, what would be, what is the advantage of them not mining this data and instead of saying we have an inventory shortage out there, there's no available homes for for sale or for rent, what is the advantage of them doing that?
I mean, it's the FOMO advantage. It's scarcity. People will learn about it in economics. The idea that something's scarce makes it more attractive. And so I think that there's people that understand this, and then there's people that just are too lazy to do the work to figure out what's really going on. But I think with anything you're trying to sell, you say things like, available for a limited time only, or blah blah blah, to make
But these
everybody
are
believe.
these are associations that I feel have a public duty, a public
I
responsibility
agree.
to give, honest data. I mean, and I struggle with it. I think, like what if we can't, now I'm getting to the point to where when I see a publication and I see what association they're citing the statistics from, I'm like, I have to click off of it because I know I can't use that as a valid source of information.
Correct.
And so that makes me do what you do, and that's get in the car and drive or go
Right.
to, other people that are mining this data that are saying, look, this isn't right. Right. And so, yeah, it's crazy. All right, we'll
It is.
keep taking questions.
We have just a statement here. Super Cash, thank you so much. Thanks
you.
for the question you answered last week about using an agent over just selling to investors. My computer froze and I was trying last week.
Thanks so much for your super chat.
Thank you very much. Got a question here. Has Zillow changed their false reporting, more targeted valuations?
Yeah, well, Carlton, he knows how much I love
He
Zillow.
knows.
So, I think more people should love Zillow the way that I love Zillow.
Right.
Yeah. I mean, Melody, I'll tell you, it was amazing through, when I have listings, when I've had listings over the last several years, personally, and I price my home for my seller, Zillow would match that price in most cases. They would be $40,000 or $50,000, and then overnight they would adjust their estimate to match my listing price.
Yep.
I mean, have you paid attention to? Do you give any attention at all to
Yes.
Zillow?
Well, I mean, I laugh. That's what
Yeah.
I do at Zillow. I mean, when I go look at those estimates, I'm on the floor. I mean, it's hilarious. And they're just so horribly wrong. And they some of the listing sites are a little bit more responsible. They may take the kind of the last appraisal they actually have, which might be what it last sold for. Zillow, on the other hand, no responsibility. Every single email you get from them talks about projected home prices next year, how many homes, what they sold for. But when you actually look at that data, I mean, they cherry pick the comps, right? They cherry pick the best information. They have the least amount of listings for sale of almost all of the listing sites, and the most sort of exaggerated guesstimates out there that I've seen.
You know, depending on what source I mean, Zillow has said it themselves, but it says here, according to the Wall Street Journal and other profitable home listing and real estate advertising companies, that Zillow loses nearly 530 million overall. I heard it was like 700 million, but they couldn't even look. That was on their Zillow offers, them buying houses
Right.
to sell
Right.
for a profit. I mean,
Yeah.
their own, they couldn't even trust their own Zestimate. They had to shut the freaking company down, for goodness sakes. And I mean, here's the thing. Whose money did they lose? I mean, this is like play money, right? I mean, it's
Monopoly money.
like
Yeah.
Monopoly, right? I mean, it's not their money. I mean, it's investor money. So, I mean, right? I mean, I'm
Yeah.
not an expert on,
Yeah.
stocks and investments, and certainly you don't want me to be your financial advisor, but because I'm not. But I mean, I think they said themselves it was like 770. I'm pretty sure.
Yeah.
Anyway,
that
a lot of
sounds
money,
right.
770
Yeah.
million, almost $1 billion anyway.
Right.
Yeah. All right. Let's
Right.
take another question.
I just wanted to see, Joe, can you pull up that poll really quick and see where we are with that?
Oh, and whether people think the interest rates are going to, the Fed's going to,
Yep.
we got a poll out there. We'll
Yeah.
see if we can see what everybody thinks about where interest
Awesome.
rates are headed.
Okay, cool. We'll get to that in a second. Yeah, of course. Of
Charlton,
course.
we appreciate you as always. We love your comments. Keep them coming. Thanks
Absolutely.
so much.
Traveled around out west lately. Hurricane Utah seems to have lots of building going on, plenty of places for sale. Also, seems Airbnb overbuilds.
Yeah, and that's everywhere. And I think, Todd, we might have talked about this a little bit, but your so-called data providers are doing no one any favors. If you go to Airbnb's website and you put in Salt Lake City, and you say, I'm looking for an Airbnb, up in the top left, you're going to say 1,000 plus in this city. You're only going to be presented with 300 listings. That's their limit. They don't really say why, but it's going to say 1,000 plus. And so often when you ask somebody, how many Airbnbs do you think you have, say in Austin, Texas? Oh, 1,000. No, there's 14,387 short-term rentals listed. So, I think that all of these service providers have done a great disservice to people that got into this space looking for passive income. Number one, I don't think real estate is ever passive income. I think you have to actively manage it. But two, they kind of made it seem a lot simpler than it really was. And I think that a lot of people, based on that, don't have a true understanding of how much of this Airbnb is out there and how much of it was built just for Airbnb, just to list for short-term rental.
What do you think about, let's talk about the poll. Melissa's got it pulled up here. All right,
got the poll.
365 votes.
Yep. Will the Fed pause rate hikes for the remainder of 23? We've got 66% coming in at no and 34% with yes.
Melody, what do you say?
I say so they may pause, but if they actually started cutting rates, it would be because we had some horrific credit event.
Or war.
Our war, which we're getting closer each day. So something like that. Because oil prices, right? Like if I could see something like that, I just don't know if they do it in say 3 months.
My prediction is they're going to raise another quarter of a point. I think they're going to go for it. Because of really two things. One, we all know inflation's not coming down. I mean, and it's crazy because they look at this as year over year primarily. It should be month over month, not year over year, because
Right.
I mean, it's crazy how they do these numbers. But we're nowhere near 2%, and I mean, when you may as well raise them now and get it out of the way. The other thing is our unemployment rate. I mean, they keep saying, and this is a mystery all in itself, because where's everybody? I mean, if you look around everywhere, people, they don't have help. I mean, I went to have breakfast with a friend of mine, and it took us 30 minutes after we ordered to get a couple of eggs. And, and the waitress said, well, we only have one cook. I mean, it's a freaking restaurant place, IHOP, right? And I'm looking at him going, you have one. Why didn't you tell us that when we sat down? No one has help, but yet two people
Right.
are out smoking cigarettes on the curb, it seems like, or what, hanging out, whatever. I don't know what's going on. I don't understand it. But if the Fed's looking at the same metrics that they're putting out, where they say, "Oh, we just created, all these jobs
Right.
last month. Unemployment is still historically low." Why wouldn't they raise interest rates? Do you think he's really going to be concerned about the National Association of Realtors? I mean, are we really
No.
concerned about jamming houses down people's throats at this point?
No. And so I agree with you that if he can get away with it, I think he will go for one more, depending on what happens. And I think based off that jobs report, that I think most of us who dove into it and looked at the household survey understand that this it didn't make any sense and it won't be sustainable, and that the highest record of two people working jobs. So it's just, I think there's a lot of noise in the data. We know that I think only 42% are responding to that BLS survey now. Like, I mean, they're just, everything has sort of fallen apart. And I think you can find a data metric for whatever you want to support at the moment. And he wants to, support his inflation fight. And so unless we have an exogenous event, I could definitely see us going with one more this year.
Do you think it would matter? So let's talk about that. And then I want to kind of get your prediction on where you think things are going with inventory and home prices and things like that. But do you think, let's just say, I mean, what would be good? Let's just say that they dropped interest rates. And I mean, we know that mortgage rates really follow the 10-year bond market, right?
Right.
But let's just say that mortgage rates went to 7% or 6.5%. Based on the the economic situation with oil prices and everything prices, really, just, insurance, taxes, property taxes. Would it matter based on what home prices are right now? If they dropped rates to 6.5%, do you really think that would have that much of an impact on the housing market?
Absolutely not. We can just look at the existing home sales for that. Everybody wants to, pretend there's no inventory. No, you've got a buyer strike, you've got a seller strike. That's all it is, except for the new builds, right? Look at what happened with new home sales. Now, why did those kind of escalate in the spring and summer? Because the builders went out and affected a 15 to 25% price reduction through the rate buy downs, me while saying, don't worry about this, you'll be able to refi. But then they also paid their HOA fees for a year, their solar, maybe they promised all new appliances. And at the end of it, it was net a 20% haircut on the price. And so unless that can be affected, and we know that some of the lenders are trying or have tried and will probably try again, that it's not going to help. We have reached a level of unaffordability from a home price perspective that I really don't care what those rates go to. For your regular American, for your investors, I think they're still going to have some problems. I think, making things pencil at that rate that you just said isn't going to work. We'd have to get seriously, back near the zero bound for it to even make sense to institutional again. So, no, I don't think little rate reductions are going to help the market. They
Well,
might help with, go ahead.
no. I'm sorry. Go ahead. Finish what you're saying.
Oh no, they might just help fuel a little refi boom, and we saw that in 2010. And I think that some people may even decide, okay, if the rates go down a little, maybe I can qualify now for a refi. I couldn't before, and so I'm going to take advantage of that because I'm desperate and I need to consolidate and I need to pay my credit cards. But it's not going to be enough to turn the industry around. It would have,
Yeah.
and honestly, even with some drastic, yeah, it would. Go ahead.
Yeah, they would need, in order to refi, I mean, a lot of people don't even realize it costs money to do that, right? I mean, they have closing costs,
That's right.
transfer record
Yes.
or recordation fees. They have
Yes.
they have to have equity. They have to reappraise.
right.
I mean, there's a lot of things
Right.
that it costs thousands of dollars to refi, and I don't think that the mortgage industry is doing a fair enough job with telling people about this up front. I mean, it has to be a pretty significant drop for them to make sense to refi, right?
100%.
Yeah.
Yeah. And the only reason I think they would do it is if they were desperate. I mean, just, to like consolidate for credit card debt and or auto, with these crazy auto payments that I don't even understand. That's who would refi. And in any way, if we get those lower rates, I can tell you the government will come out with a HARP or, home affordable refinance program where they'll probably do something like try to pay for all those costs you were just talking about, et cetera. But it's still not going to be enough. I mean, we are just, I can't, I have seen escrow notices go out for double the payment, the mortgage payment. I mean, it isn't just $100. And taxes are due in California in November and December. And California is the biggest housing market out there. I think we're about to start seeing, one of the things I do is I actually still listen to calls come into the call center. And all of the calls have been about escrow. They've been about those property taxes
Wow.
and insurance. And, people are getting nervous. And so if I'm, if I have a second home down in Florida, I might be thinking, do I really want it? Or maybe I should move down there, sell my other one, something like decisions. There are a lot of people that will have decisions they can make. But there's a lot of people, and this is the people NAR doesn't really care about, the NBA, none of them care about, are your 57% of Americans who can't afford $1,000 emergency. And those are the ones that I'm super concerned about. And I don't, there's no hope for them to be able to buy a home at these home prices, in my opinion. So.
When do we start
Sorry.
seeing foreclosures? No, it's great. No, when do we start seeing home foreclosures? I mean, you had said that delinquencies are up, that really they're not being reported properly because they're not talking about serious delinquencies. So maybe you can explain the difference
Sure.
of that. And when
Sure.
do you think that we will get to a point to where we start? I'm hearing it already. I had a broker reach out to me today to want to come on the show. In fact, I want to podcast with him. He has right now he has a school, a program that he's teaching agents. And this is, look, I remember this back in 2008, where he's teaching agents how to deal with distressed sellers.
Yes.
And a distressed seller, just so everybody knows, isn't somebody that can't cut the grass or that isn't paying their mortgage. A distressed seller is somebody that must sell, right? They're in a position, they're a distressed seller. That means that they need to sell. They have to get rid of the house. So their options are, and a lot of people are saying, well, with everybody having as much equity as they have in the home, and I can't stand hearing this. I mean, every time I hear somebody say this, it just irks me to no end, because they say, oh, well, we're not going to have a financial crisis in the housing market because there's so much equity. Let me tell you something. Equity leaves the house fast when the roof
It sure
is
does.
leaking and mold's growing inside. equity leaves the house fast when the heat hasn't been working and the pipes burst and you have all kinds of problems with drywall and floors buckling and everything else. When somebody has to walk in, I had somebody reach out, one of our audience reached out and said, I need to sell this house. What do? I looked at the house and the house is in bad, I mean, it's in rough shape. I'm like, what do you need to do? You need to drop, you drop the price, right? But when you look at it, you go, the equity goes fast in this scenario, right? So, that's one thing that can happen. The other thing is they can short sale. They can deed in lieu, basically turn it over to the lender. When do we start seeing this, Melody?
Yeah, and just one thing I want to mention, because I'm the same way, my blood boils when I hear this, is, you mentioned it at the beginning of the show, but the partial claims on the FHA, equity has already been withdrawn through these workouts, but that number is not being reported to the credit agencies and it's not being reported to the Fed. And good luck trying to get what we used to call a combined LTV or loan to value. I'm working on trying to get some of that data for current MBS, because for Fannie and Freddie, also it's called a payment deferral. Same thing. Let's say your payment was $2,000 a month. Let's say you did a forbearance for 12 months. That $24,000 would be very similar to a home equity of years gone by or closed in second. But basically, they took that $24,000, put it on the back of the loan, and they're not reporting it anywhere. And so we think that they have a loan to value of 80%. When in actuality, that's not even true. It's more like 95%. So there's a lot happening that people don't actually, and I completely agree with you about how quickly that equity, that was one of my jobs back during the GFC, was to look at these books, look at the credit quality, look at the loan to value. And I can tell you it disappears very quickly too in these environments.
Well, you were at the auctions too. You were at the
I was
auctions.
at the auctions.
Yeah, that they were selling them, liquidating them in bundles, these loans in bundles, selling them to Wall Street.
That's exactly right.
So when do we see it?
When do we see it? So this time around, like what's happened right now, you'll hear every publication, we've never had, this is the lowest seriously delinquent in the last 100 years or some nonsense like that. Okay, sure. Because we had all the COVID programs, which are just now finally expiring in October. But what no one's talking about is the early stage delinquency. And they're not talking about FHA, which is at already a 9% delinquency across all strats, 5% at that 30 plus or very early delinquency. Fannie and Freddie are still low, but they are starting to creep up as well. And what I talked about earlier, that rate of change. Now, because it is so difficult to foreclose after what happened during the GFC, there are some states where this could take a very long time. Per the CFPB, a servicer has to wait 120 days before they can really refer that loan to foreclosure. So I would say there's a lot of reasons, these workouts, government involvement. What we probably won't see a serious uptick in foreclosures until probably end of Q2 of next year. However, those numbers will be steadily increasing up until then, because what will happen is your investors or fraudsters who simply can't afford it and are going to walk away. They will walk away. And by the way, I've already seen it. And this is what we call no right party contact. You can't even get in touch with them. You send them a mod in the mail. That was a COVID change. You don't even have to talk to them anymore before you send them a modification, and they still don't respond. And so it's already happening. It's just going to creep up. And then I think meaningfully it could be Q2 that we'd see this without some exogenous event or severe government intervention.
How will we see it? How will we know? Do you think, going through it before and, maybe they'll try and bury a lot of this information for a period of time. I mean, we're rolling into an election year. You say we're going to have foreclosures pick up in the second quarter of next year. Boy, that's not going to look good for, the current administration.
No.
But at what point will we start? Because here, am I right in saying this? These servicers are going to need to get ready, right? They're going to have to increase their call center volume. because
already
a lot
happening.
of
Yep.
it's happening now.
Yeah, absolutely.
They're
The
beefing
engines
up their
have to
call
start.
centers.
Yeah, and their default positions. And because the engine doesn't stop, even if you get a modification as your final workout, you still have to send out your 16-day notice. Then you got to make your day 36 call. Then you got to send out your early intervention notice. Then you got to I mean, it just goes on and on because all those regulations. And this is what the non-bank servicers don't realize because they weren't around last time, none of them meaningfully, they're all crying about the repurchase requests they're getting right now. This ain't nothing, nothing. And so I have one client, I can tell you absolutely, their cost of service increased by 30% month over month back in June.
Will we see these servicers go bankrupt?
Yes, we will. We will see some of them consolidate. It's already happening. Specialized loan servicing is being picked up by Rhythm. So who I would tell everyone to be looking out for are your your top 5 your FHA VA servicers. Because another little thing that happens is when you do a modification for Ginnie Mae, you actually have to buy that loan out of the pool, modify it, and then redeliver it, usually at a haircut. Now, just think about how high these home prices are. Just think about what that means for smaller shops and bigger shops. So, okay, yeah, everybody's saying government bailout, no problem, but the minute those servicers have to start millions and millions of dollars a day repurchasing those, all of a sudden, they've got different facilities, liquidity facilities they use for that. Whoops, that's all being used. Now I've got to pledge more assets over here. Whoops, I'm also having to write those assets down. So nothing is different this time, and they absolutely will go bankrupt.
When we look at Fannie and Freddie, they had, they were really in trouble back in the great financial crisis, right? I mean, they were like, whoops, we made a mistake. We have a lot of bad debt on the books, right? These defaulting loans, these foreclosures. Now things are a little bit different because I don't know, the government set up some other kind of criteria for them or whatever, but we don't think that's going to matter much. But anyway, just take this shift from, 2008 to, let's say, 2024, 25, when we know things are going to when they should be falling apart. Are they going to do the same thing they did back then and bundle up these loans and liquidate them to Wall Street?
So I am of the belief that's probably not going to happen. I have kind of some radical theories. They've figured out how to put a lot of this risk back on the non-banks, so they will do that. But I have a feeling we might see some crazy stuff like Fannie and Freddie becoming servicers and managing and taking some of this on their books. Actually, this isn't something they've done.
Maybe it's a plan.
Yeah.
Maybe it's the plan. Maybe Fannie
Right.
and Freddie will be landlords.
I definitely think that's in the future. I really do. And especially on the multifamily side, a lot of distress over there. And all these empty multifamily I've seen on the road, like Evergrande style, I have a feeling that this could be, part of the financial repression that many think is on its way. And the government is going to, take over 100% of the mortgage market versus 95%. So,
I have a client looking at a commercial building. It's tax assessment, $6.4 million. It is back in receivership to Wells Fargo. And Wells Fargo wants $3.6 million, is what I was told, will get the job done. 6.4 million tax assessment, 3.6 million.
right.
And basically
Right.
what their agent said, commercial agent, what their agent said was, look, bring them a lease. Wells Fargo will be willing to be the landlord. Oh, what? Like, yeah, they'll do a rent to own, they're willing to do just
Right.
about anything on it. I'm like, wow. I mean, so maybe maybe that is the plan. All right, let's take some more questions. I know I look, Melody, I mean, I love talking to you. I mean, you have so much wisdom and experience, and it's so refreshing to hear it because sometimes you feel like, you're in a camp all by yourself, and you're like, you start to say, is it me? Am I, you know, what I'm looking at things and I'm going, this doesn't make sense.
Right.
And, you know, it's nice to know I'm not crazy. So
I
let's
don't
take
think you're
some
crazy.
questions.
I'd like to address the super chats first. We have Charles here. I was quoted an interest rate of 7.5% for a VA loan for a $300,000 house. It would be almost $2,600 a month. Prices need to come down. This is crazy. Also, my realtor said people are still buying in California. WTF.
Charles, thank you so much for the super chat. We appreciate you.
Yep. And Marco, I know he really wanted me to read this. He's been messaging me.
Did we, was there something that we needed to pull Charles back up there?
Oh, sure.
I would just say that the all cash buyer seems to be omnipresent and ubiquitous, and I would question that. I think that that is a narrative everyone uses to scare everyone, but there's this little trick that a lot of people do, for instance, to get around the commission rules from National Associates of Realtor, that they'll put a home is coming soon and they'll be marketing it in the back end, and they can do that for 21 days. And then the minute it hits the listing site, they'll say, no, it was sold to an all cash buyer. I mean, who knows? But honestly, they've been marketing it the whole time. So this isn't as another narrative. Ask for facts. That's what I would say. But anyway, yep.
Yeah.
Okay. Thank you. We've got another super cash here. Team, what do you think about Steve Eisman, short seller in 2008? He thinks the American consumer is in good shape. He was on CNBC today.
Yeah, Melody, are you familiar with that?
Oh, of course. I mean, I'm seeing a lot of my old, I'm seeing a lot of people miss this, and it's, but I think it's all about where you're sitting and your view. And I think that, you know, maybe this time they're just not sitting in the right place to see what's going on, and that the narratives have become so strong. I mean, really smart people that I know talk, you know, they just have bought the inventory narrative because they haven't had time to really dig into it. They're taking the Fed's numbers at face value. So, you know, there's a certain consumer that's doing just fine. And that's our top, you know, 20%. But even some of them are kind of coming under stress. The super prime, I'm seeing that happen. But the rest of our Americans are not just fine. And this will, just like the K happened, you know, remember the K? I think it's just going to, the K is collapsing, and it's going to collapse from the top and collapse up from the bottom. And we're going to be a pancake pretty soon. So, you know, what can I say? I think some people are just missing it.
Yeah, Marco, we appreciate your super chat. So, Melody, are consumers in good shape? I mean, this is the thing. I mean, this is what we're hearing, right? They have equity in their homes. Americans are in great financial shape. We're almost at $1.3 trillion in credit card debt. We're seeing that millennials now, for the first time ever, are late now on their, by, you know, massive numbers. They're late on their auto loans. They're late on their credit card payments. They're starting to be late on their mortgages. You know, how do we say, who says, you know, I don't even want to go down this road.
It's one type of consumer. It's that top echelon. Guys,
maybe
quickly,
the top five.
Yeah, maybe the top five. Quickly, I just want to let you know my battery is running down because I've been using my headphones.
No problem. We might lose Melody.
If I just disappear.
All right, we'll know you're gone, man. And Melissa and I are going to have to carry the torch. We got a lot to talk about, but let's try and get as many more questions as we can for Melody.
Sure. Yep. Right. Let me just scroll right up here. So, did Melanie Torr build locations only in volatile to begin with areas, or did she go to markets that are historically stable too and see the same overbuilding?
Well, I guess I would ask what historically stable it means, but no. So of course I started with the stressed markets, but in that very first trip, I went to Charlotte. I haven't heard a lot of people talking about Charlotte. I can tell you it's a mess, but Pittsburgh is another. You know, Las Vegas, people don't talk about being in a ton of trouble. Phoenix, they do. You know, most people weren't talking about Florida being in trouble at all when, I first went there. And even now you should see the hate I get on Twitter. But I'll go to any market. But what I would encourage people to do, if you're curious about your area, Pulte usually has a great map. Just put in a city, you'll see all the new build sites. And if you go to those, you'll soon find that other people have kind of glommed onto them. So you'll get a sense for yourself. And the other thing, I'm happy to go anywhere, but I also utilize my Twitter network, and people go out and take pictures for me and video out like in Bozeman, Coeur d'Alene, Seattle, Portland. So I guess, is there a safe market? The Midwest is the safest right now. And I have been out to Ohio as well and seen a lot of new builds out there. So
Yeah,
hopefully
but
that helps.
they're more affordable than any other area in the
Oh,
country. I mean,
100%.
that's why
Yeah.
people are going there. Yeah, the problem is
That's right.
jobs. So, when you look at areas like
Yeah.
Florida, I mean, I don't know that they have enough jobs to sustain the amount of people that have,
They don't.
migrated, their domestic migration, and they're building these houses and people are, getting called back into the office again. And, now what are they going to do? So, I mean, I think it's a mess. DeSantis doesn't want,
Yeah.
he doesn't want to hear that right now, right? As he's,
He's really messed up. Yeah.
running for president, but
Yeah.
I think they're going to have some
In a
issues.
state that's right.
And
There's
Florida
just an
was,
article today that rent is the most expensive, is in the top 5 most expensive in Miami. Like, so it completely going counter to the idea that Florida is affordable.
yeah. All right, let's try and get a couple more questions
Before I disappear.
before she disappears.
Just going to bang them out. People got suckered into those 2-1 or even 3-1 buy down options. And I worry if they were banking on a change because real estate agents are trying to predict the future.
Totally. And I've called this in my Substack, the arms of this cycle, because these things are going to reset just like an arm. But everybody's looking at that pie chart that says, here's how many adjustable rate mortgages we have. Here's how many fixed. Well, guess what's in that fixed rate pie? It's those buy downs. And so a lot of people don't realize that, and the rates are going to reset. And that's, as I was saying, a lot of that's hitting actually right now because the builders started this in earnest in July of 2022.
Mm-hmm.
So your recommendation or advice to people buying a house is to not take an arm?
I would not, but everybody's situation is different. So, you really have to take all of it into consideration. But if it were me right now and I didn't have to make a decision, I would not be buying right now or taking a mortgage.
Yeah, you wouldn't be buying at all.
That's correct.
Yeah.
Yeah.
I think you said that you would wait at least until 2025, right? You would try and get through.
Correct. Yeah.
So,
I would.
Yeah, I mean, look, I say to people all the time, I mean, there's really, you have buyers that don't really care about the cost.
That's right.
And, they
Yeah.
want it no matter what the interest rates are. And I say,
Right.
if that's you, go for it. If you find something that checks
Right.
your boxes, do it. But,
Right.
it's hard to look a first-time buyer in the face right now and say, I think it's a good time to buy.
Right.
I'm nervous for these buyers, and I know that a lot of people
Right.
want to buy, and it doesn't make sense for someone who gets paid to sell houses to say that. But at the end of the day, I mean, at what point do we care about people more now than our wallet, right? I mean, we have to really look and say it's a scary time. I mean, I believe the house prices are higher than they have ever been. Mortgage rates are at a 23-year high. Savings accounts are at all-time low. The job market is, I mean, look, things cost a lot of money. People are wondering, how they're
Right.
going to buy groceries right now. What I would say is, if you have to move it back into multi-generational housing, don't be
Totally.
afraid to say, hey, can I live in the basement for a year and see if this thing shakes out and, save money. if you
Exactly.
can. And I think millions of millennials have done that. And,
Right.
I think it's okay. We've gotten to a point, Melody, where we put too much pressure on people that they must keep up with the Joneses. All right, let's try and squeeze a couple
I
more.
totally agree. And there is no need when your future is at stake to do that.
Yeah, you can't rightfully
I,
do it.
right.
I'm going to move on to the next one. The problem is when it hit the fan, can all these government agencies support all these negative notes?
Not in the way that people think.
If we let the
Not,
government print as much as they want, I heard an economist say today, it was the craziest thing, man. I'm going to try and get her on a podcast just to because. But she said that basically the government should be allowed to do whatever they need to do to print money, and that the government's red ink is our black ink. What do you think of that, Melody?
no, no. And I personally am of the minority, but I don't believe that we can print our way out of this. Will the government be involved? Will there be financial repression? We might all get jobs bulldozing commercial real estate. I don't know, but I don't think we're going to be able to print our way out of this completely.
Well, she also said that we need to get over the mindset of the gold standard. That is, that's for old timers. That now we can't worry about that. That the government was able to print all this money and give us stimulus and pay our mortgages and pay for our rents and blah blah blah. I mean, it was the scariest video. I watched the video. It was the scariest video I think I've seen in years.
And we have the worst inequality, we've seen since before the Great Depression. So, there are consequences for this. And I think the social consequences would be enough because anger is building. There's 600 homeless people in Missoula, Montana, who used to not have a homeless problem. Guess how many short-term rental listings they have in Missoula, Montana? Very close to the same number.
Wow.
So but people are getting angry, and this will become a very political issue. And we're already fighting over the debt. I mean, we've seen what just happened. And that HUD bill is one of the things that people are fighting about. So although I think they will get involved because nobody wants, this kind of issue during an election year, the extent to which they can truly turn this around and not just do something to get us through 2024, which they've done in many ways on, the student loans. Maybe they'll do some surface stuff, but they're not going to be able to turn this completely around.
I see
unless
more.
the UFOs come.
I see more people on Instagram talking about living in vans, living in their car, and they're turning it around that, hey, they're traveling the countryside and things like that. But I mean, this is, there are people that are legitimately living in their cars and keeping a gym membership so that they can take a shower and, get dressed to go to work. But they're literally living in their car if they're lucky. It's like you said, the homeless population is growing like crazy. And,
Yeah, because the same time that there's no housing, essentially no one can work in these tourist towns anymore and find a place to live. So when I was on the road, actually, I met a lot of the hospitality workers were staying in RVs, staying in campgrounds. And then and I can't even remember who told me this today, but that basically people are leaving RV parks to go find a more affordable place to live. What is that? You know what I mean? Like things are getting really desperate and our mainstream media doesn't cover it. I mean, that's what's crazy. And most of the people like Steve Eisman read, the financial press and all they talk about is rates. They're not talking about the fact that the food bank in Phoenix, the people that used to work there to give out meals during COVID are now coming there because they don't have enough to eat. These aren't the stories that we're hearing. And these are the stories I hear because when I travel, I try to watch the news locally because I can't really usually watch it. It just depresses me too much. But you can hear these stories on local news stations. You can't hear them in mainstream media. And it is dire out there, everybody. And so, I would just say, like you said, Todd, we have to get out of our echo chamber, go drive around, ask questions, ask your barista, ask
Mm.
somebody how they're doing, and they'll tell you how they're doing. And things are not going well. And so, for whoever wants to say the consumer's doing great, those are the people that are in the top 20%. And by the way, those that I know that are there, they're also like, wait, what? They're looking at their bills suddenly and they're realizing that they're probably going to have to start curtailing spending as well, because they're not able to put aside enough, or the regular amount for their kids' college tuition. So it's hitting everybody, but it's really hitting our bottom 80% very hard.
When do the prices come down?
So I think, I think certain prices come down. We'll talk about houses specifically. I think we'll end the year on positive home price appreciation. I think we'll probably, barring war, barring an exogenous event, or extreme government intervention, we'll probably see about a national 5% price decline next year. In some areas, it could be a lot more, depending on, like Austin. They've kind of had their really bad leg down and kind of stabilized, but from everything I'm hearing out there right now, they're about to have another severe leg down. So, but I think nationally, because of those what are called more stable markets right now, it'll probably be around the 5% next year. And then in 25 is probably when you're going to see your largest price declines. And kind of my model says around 12%, with 2 years following that of corrections continuing. But, to me, certain markets will go sooner, and in those you can negotiate. So it's good to really know your facts about what's going on, and you might be able to get in a little sooner than that.
Yeah. It's interesting because, when we're talking about, home values and, home values are based on comparable sales. So when we're not getting comparable sales, so let's just take maybe three, right. Let's just take three sales they want to see, like within that subdivision, right? You have very limited inventory right now, but you have very limited demand because of high mortgage rates. So what happens is you get a couple of those sellers that they need to sell. If they're advertising their house right now for sale, they have to sell, right? They're not like, well, I think I'll sell my house because it's such a great time to do so. No, they're selling it because they must sell, right? It's a bad time of year historically to sell, cruising into the holiday season. Kids are back to school. We know seasonality in the housing market. This is not a good time to sell. So when we see people putting their homes on the market, they must sell. Now, when those homes sell for less money, that's your new comp.
Right.
That's your new comparable. So what I'm thinking here is, let's just say we have a $500,000 house that takes a 10% haircut, and this happens 3 or 4 times that's the only comps because they're the only sales. We cruise into 2024 with that 10% haircut, right?
Yeah.
So I think a lot of it is going to be based on people think that the prices can't drop because of lack of supply. We know that's not supply. There's a lot of hidden supply, as we've heard earlier this evening. But the big thing is that the sellers that are selling right now, they want to sell. So with lack of demand, a lack of affordability, we may see, especially like you said, in those certain markets, we might see, some of these markets decline quite rapidly. But yeah, it's amazing. Let's try. She hasn't gone away yet.
And let me just say, if we do have job losses, we do have, and that's what I mean by a credit event or something like that, then this thing could gain a ton of steam, and it could happen as quickly as those prices ran up in 2 years. They can come down.
So how many vacant homes did you say?
About 15 million per the census that are
So let's put this into perspective. They're saying that we're going to end up this year with about 4 million home sales, right? 4.1 million home sales, right? Put this into perspective. That number, the inventory number at 15 million vacant homes, with all of these people that bought in COVID to get out of their areas, cities, New York, California, right, Washington, right? All these states that you saw mass exodus, or even if it was only temporary, right? They bought these extra second homes because they didn't want to be on lockdown in their city. So they had money, they had all this liquidity, their stocks are doing great. It was an everything bubble, right? And some say we're still in the everything bubble, and I believe it. But, so they bought this second home inventory thinking that the world was great. Now, all of a sudden, it's not so great. Things are costing a lot more money than they expected, and their savings accounts are dwindling. Even the ones, so let's say the 95% of the Americans, not the top 5, right? So now they're watching their wallets get depleted, and they're going to be saying, hey, man, we need to dump this property. And if prices start going down, the time to do it is now, not wait until 6 months. If we know already that we're going to sell and we're hoping to sell in the spring, because I think a lot of people that I've talked to, they're like, yeah, we're going to wait and see what the spring market does. We'll wait and put our home in the market in the spring. Well, once we get this rush of inventory, if we're still looking at north of 7% mortgage rates, prices coming down, folks.
Yeah. List
Prices
it now.
are coming down.
List it now, please. Yes.
Yeah.
And everyone I see, I tell this. And I mean, I met someone picking up dinner last night. I was like, list it now, because there is so much of this excess inventory out there that people are like, well, I bought this home. Anecdotal stories of a colleague out there went to dinner with 2 other couples his age. Each of them had bought 2 short-term rentals. They now couldn't fix them up. They had bought them to fix and flip, and then they couldn't get financing on the fix and flips. So at one table of, basically 6 people, you had 4 vacant homes. So this is a real phenomenon. And for whatever reason, people don't want to believe it, but these homes will be coming to the market, and you don't want to be in the last person in the door at that stage. And I'm seeing it in the super prime where they bought 9 properties and they're like, oh, I need to let this one go. And then all of a sudden they're like, oh, I can't sell this one. Okay, so maybe I need to let this one and this one go. It's just beginning, but it is picking up steam as we're rounding the corner in a non-seasonal time. Even the Fed, even Housing Wire is talking about inventory rising. So that should be a warning signal to everyone.
Yeah, for sure. Yeah. All right, can we get in another couple questions before she disappears on us?
Absolutely, Melody.
Scary.
It's scary.
It's all right.
It's holding on.
It's holding on. Okay.
We're all rooting for you.
Question about the Denver market. Why are prices still holding up so well in metros like Denver? Should we expect relief in 2024?
So Denver is always so interesting to me. I'll be out there actually November 19th. So I may even do a meetup out there.
There she goes. Now you're stuck with me. The Denver market. I don't know the Denver market, but I do know somebody that's out near Boulder, and they just got another investment property. So prices must be dropping. But I do want, guys, and Melody, we have Melody's information in the show notes. We're going to hang out for a little while, answer some more questions. I have some charts to show you. But what a fantastic guest. I mean, guys, she's amazing. Huh?
God, she's good. I mean, she is amazing. Terrific.
Yeah, she's amazing.
Awesome.
So we have her YouTube channel in the show notes. And over the weekend, I mean, her video, we've had 100,000 views since Saturday. Her Saturday video, it's amazing.
Definitely check it out. Solid video. Yeah.
We have her information in the show notes. You make sure that you show her some love and subscribe to her, and tell her how much you appreciated her input tonight, because she's amazing. And, and that's the big thing, is that everybody, I mean, there's still cheerleaders, but it's starting to crack. We're starting to see where people that were saying, oh, this would be temporary. It's not going to, be sustainable, that the housing market will stay slow. Buckle in if you're in the market. But I do want to go through, because she had touched on the Housing Wire, Joe. We can pull up the Housing Wire article. Inventory growth. I think this is the one we want to show you guys. I have a subscription, so you guys may not be able to find this unless you subscribe to them. It's kind of an industry publication here, but inventory growth slows even with higher rates. And I want to just kind of look at some of these charts right now, because here's what we're talking about, is inventory rising. So right now it's looking at October 6th, about 537,000 houses on the market. And when she's talking about 15 million vacant homes, I mean, you could see how much this inventory could change in a moment's notice.
Yeah. It's a shocking number.
And then as we get into, the listings that are coming online, this is what I was just talking about. Guys, the people that are listing houses right now, like I said, they really need to sell, but buried in here in 2023, October 13th, new listings that hit the market, 59,458 as its respective, 2022, obviously, right about the same as 2022, but even down from 2021. So these are new listings where people are saying, well, I think it's a good time to put my house on the market. Obviously, if they're paying attention to the news, it's not. And then here's our single family housing with price decreases. And this we kind of covered last week. So what we're looking at here nationwide is about 37.5% as of the end of September. And it always amazes me how maybe by design, I don't know, you hate to say that, but at what point now are we looking at October data in the prior two charts? But now when we're getting to the point to where we want to know are people dropping their prices, it kind of stops, right? It lags behind. Well, there we go. October, a week ago or last week, 37.9% price decreases. Treasury yield, this is what we're talking about with mortgage rates. It kind of goes hand in hand. We can see back in 2020 how low the 10-year Treasury was. And, this is what we're looking at. So when the government is paying investors 4.5% for a 10-year Treasury note, why would they invest in mortgage-backed securities? It would have to be much higher. And here is the MBA purchase index showing that mortgages are at an all-time low October 4th. The very low demand on mortgages. But yeah, let's take some questions and
Yep.
So
You
we
guys
got-
are very, very active on here. So we're just going to continue to go down the list. I'm dealing with squatters right now, wondering why rentals are being bought by corporations. With these revised rental laws, I will never own a rental property in Colorado.
Yeah, so the mom and pop landlord is really getting squashed out. In Maryland here in October 1, tenants are entitled to attorney representation. And I guess they're going to give them one. The government will appoint them one, I guess. But in a certain income bracket, if someone's being evicted, basically what's happening is they're building tenant unions to go against the landlord because they're being evicted for whatever reason. Most of the reasons are because they're not paying rent or they're not taking care of the place. Or both. So, not saying that's, a blanket across all landlord-tenant relationships, but as we see with the eviction moratoriums, through COVID, the power that the government has that basically says that you cannot throw someone out of your house. We're going to give them, money. We're going to give them unemployment, I think, for however many weeks it was, 6 weeks or I think
so.
$700 subsidy, federal
Yes.
subsidy, but yet they didn't have to pay their rent. I mean, what they should have said is, look, we're going to pay you unemployment. We're going to subsidize your unemployment, but you need to pay your landlord, right? And then they, basically just crippled the landlord. So a lot of people, and then we know in Los Angeles, this is still kind of going on. There's a backlog in evictions. Some landlords are paying their tenants $10,000 to vacate the property. To get it back to where they can sell it. I personally know a lot of landlords, mom and pop landlords, that have said, I'm out. It's no longer a good deal making $400 or $500 a month. And what would be profit to turn it right back around and, renovate the place again in a year or two after their tenant leaves. So we see that these corporations are buying these rentals because I guess it's not real money.
Yeah.
I mean, they're not the investors aren't on the deeds, right?
Mm-hmm. And the next question, I mean, it follows through with this. The question is, where is the opportunity in all of this?
Yeah, I don't think the opportunity is owning residential properties anymore. And I think we have monopolized housing so much that I think that ship has sailed.
Yeah. The infuriating thing for me is that since government holds the most mortgage paper, the taxpayers will bail out the Airbnb investors. Am I right?
I mean, the government says that no. I mean, taxpayers aren't paying for any of this.
That's what they say.
I mean, it's taxes aren't going down, but I don't know. I don't think that Airbnb investors are going to get bailed out because they're mostly consumers.
Mm-hmm.
They're not corporations. They're not banks. They're second homeowners.
Yep.
So I don't think so.
So many people are going to get hurt. The writing is on the wall. This is going to be a disaster, which we know and we talk about it. We can't.
Yeah, I mean, I hope you guys got a lot of good information tonight as to how quickly this housing environment can change. I mean, what we're talking about right now is millions and millions of vacant housing. Whether it's, builders not reporting their new construction inventory, whether it's, short-term rental or long-term rental investors, vacation rental owners, whatever it is, millions. You heard Melody say it's stated 15 million vacant houses in America. If we get a fraction of that inventory hit the market all at one time, even a quarter or an eighth of that inventory, it is going to make a tremendous impact in home prices. They're going to come down. I mean, it's just right now with interest rates as high as they are, I don't see rates going back down to 5%. I just don't see it. I mean, I think even if Jay Powell, does a pivot, there's that word we haven't heard in a while.
We haven't heard
pivot.
it for a few weeks.
And if he pivots, they pivot and they start backing off, and we see the Treasury note drop, and we start seeing 7%, 6.5%, 6.75%, which will seem like a ray of sunshine. It still is unaffordable. I mean, it was going up. Things started shutting down in 2022. We didn't end up at 8%. When we started raising interest rates, we were going into 5, 5.5%, 6, 6.5%. We saw the market shut down. So if we go back to that, there's going to be no magic here, right?
No, there's not going to be a match. And this is a very good point that someone just made here. Didn't she say 15 million vacant homes per the last census? Wasn't the census taken before the pandemic?
There was.
Yeah.
There was. Good
Yeah.
point.
Very good point. So we'll continue here with some questions. I just want to make sure there's no super chat, and there is. I want to absolutely get to this. At what point should housing prices come down? How high or how long does interest rates have to be for that? Or is it after unemployment doubles?
So we have seen home prices decline. This is a metric that's very difficult to put your finger on because it's all based on median sold price. So when we're looking at when they say the median sold price, I can tell you that we are not seeing the madness that we saw in the beginning of 2022, 2021, and the end of 2020, where we were seeing $50,000, $60,000, $100,000 over list price, where we were seeing people pay $100,000 over appraised value. That is not happening right now. What we're seeing is that if a seller doesn't list it where it should be, they're sitting on the market and they're actually selling it for less than what they could have had they priced it right in the beginning. So we've already seen a massive shift, crash, correction in the housing market. If you look at 37%, 39% of the houses In Baltimore City, it's almost 50% of the houses for sale right now in Baltimore City have had price reductions. These have been, a lot of them have really been significant price reductions. It's still not enough to put the house under contract. So as we're starting to see inventory pick up, days on market pick up, no, we're not seeing a lot of people selling their houses, but this inventory is stagnating and the prices are correcting and coming down. So we are seeing a major price correction across the country. Now, what Melody just said is that when we roll into the spring, and this is all speculation based on the job market, based on the ability for them to bring inflation down, based on us being able to get fuel costs down, which, I mean, they're going in the opposite direction right now, even in the last couple of days. So when we're starting to see, gasoline at $4 a gallon out in California, $6.50, $7 a gallon for gasoline, diesel fuel even more expensive than that, and all of our products and our goods are coming in some type of fossil fuel system, whether it's a truck or a train or flying an airplane. All product prices are going up. We're starting to see people put fuel surcharge on products on the wholesale side. Inventory, products of goods and services are not really adjusting to where we need them. And so you take that and now roll into the spring market where we see a couple million more houses hit the market all of a sudden in quick fashion. Then we start seeing, short sales and people not being able to pay their mortgage and trying to liquidate their homes before they get foreclosed on. We could see a spring market that has a significant amount of inventory of distressed or sellers that need to sell, and we could see massive price reductions at that point. Melody said 5%. Okay, maybe it could be 5%. 10% would be a massive correction from where we are right now. And then she said as we get into 2025, even more price reductions. So I think as we see this thing unfold, if you're really trying to wait, probably, and you can always jump in the market, but if I were to advise someone, that really can't afford a house right now, I would wait until probably 2025. I would see how this thing shakes out.
She made a very good point of the 2-1 buy down. That term is coming up for it to reset the rate.
There'll be a lot of unhappy people that are going to want to sell.
Those 2 years came very quickly for those people. And now it's a potential that they're in a big jam.
100%.
So just wanted to reiterate what you just said. Did I understand correctly that by 2025, we'll only see a 12% reduction in the price of homes? They went up at least 35% in some markets, but only a 12% by 2025. California?
I think that what we're going to see, if we look back at the great financial crisis, overall price reductions weren't 20%. What we saw the major price reductions on were distressed properties where people were foreclosed on and, the home needed work. You couldn't get conventional financing. If we take, wouldn't we like to see a 20% reduction? If a house is $500,000 right now, if you could buy that house at $400,000, wouldn't that would be massive, right? The issue here is that your neighbor at that point paid $100,000 probably more than you did, or $120,000 more than you did. I would like to gain that $120,000 in equity. I don't think we're going to see 2019 prices come around. I just don't. And I think a major price correction, in the beginning, I said 10%.
Yeah, you did.
In April of 2022, I said a 10% correction. I think we've seen that in some markets and more. Mm-hmm. All luxury homes are overpriced. If you're in the luxury home market, you're getting crushed right now. If you're selling a $3 or $4 million home, you're getting crushed right now. You are literally taking 20%, 25% price cuts in a lot of cases. So it all depends on the price. So if we're looking at a $400,000 or $350,000 house, do I think you're going to get that house at $150,000? No. Mm-hmm. No, I don't think we're going to see that. I really don't.
How about this question? Tell us how to become homeowners in the future, what to watch out for, etc. This is going to be like the car gurus talking about the car crash that's coming.
Man, and you guys, if you're real estate agents, you're not going to like to hear this, but and this was on tap for me to talk about tonight. You buyers need to be educated. There's a couple things that are happening right now, and I love this question, and we're going to be diving more and more into this, but this is, I wanted to talk about it tonight, and now's a fine time to do it. But, what we're going to be looking at with the market the way it is the housing market as we've known it for the last 120 years, thereabouts, is quickly tumbling down. The National Association of Realtors is under extreme scrutiny right now, class action lawsuits. October 16th in Missouri, we have a federal case, first class action case, looks like it's going to go to trial, where the defendants is the National Association of Realtors, Berkshire Home Services, and Keller Williams, it looks like. They have yet to settle out. Anywhere that owns Century 21, Better Homes and Gardens, Sotheby's, yada, yada, big conglomerate. They settled out. Then we had Remax settled out. And now we heard where Redfin, these three companies now, Anywhere, Remax, and Redfin are now claiming partial separation from the National Association of Realtors. And this association, the longest association in the United States that has governed the housing market and the way that we do business and the way that it restricts agents access if you don't participate, and you have no MLS access if you're an agent to participate. This house of cards is coming down, in my opinion. We know this because it's in the news right now, and there's a ton of scrutiny on the National Association of Realtors, and people are starting to sue, saying this is why, one of the reasons they believe that the housing market is so out of control right now. You buyers are going to have to learn how to not be represented, because there may become a day where you have to pay for your representation and you may not be able to. As we're looking at, most buyers in America have less than $5,000. Look, the average in the frenzy, money down on a purchase for a first-time buyer was 6% down nationwide. That was the average through this madness, okay? First-time buyers weren't paying cash. They were putting 6% down, and most of them, I think over 30%, over 40%, I believe, had gift money from parents because they would have never been able to do it. So when we look at you buyers out there that are trying to buy, that have been kicked to the curb, waiting on the sidelines, you're going to have to learn how to act on your own, okay? You're going to have to become educated in the process. You're going to have to be sharp, right? Because you might be negotiating yourself. And quite honestly, I think, and I'm advocating for real estate agents because I think professionals have their place in the market. I am a real estate broker. I am not in this business because I think that my job is going to go away. I think that the good agents and great brokers are going to need to be around, because at the end of the day, people are going to quickly realize it's not easy buying and selling a house on your own, despite the people that want to get keyboard, statement that, oh, you're wrong, I sold plenty of houses, blah, blah, blah. Let me tell you, it has been proven time and time again that you are better off with representation than not. Some people want to spout off and they want to say, well, I'm going to get a real estate attorney. Good luck with that. Let me find out how that, tell me how that worked out for you when you call the real estate attorney that's booking $500 an hour. They're going to drive you around on a Saturday, Sunday, Friday night, Thursday night to look at houses. Ain't happening, right? So you might have to do some of this on your own. So we're over the next couple months, we're going to be teaching you how to do that, right? We're going to have some shows that are going to be geared to that. We're going to talk about it on our Tuesday night podcast. But I want to tell you right now that until then, until you need to learn how to do it all on your own, you better start looking for a good agent. And I'm not talking about your best friend from college that sold 3 houses or just got their real estate license and thinks it's a good idea to help you buy a house, right? Because you're going to have a window of time that you're going to need to dive in And when things check the box, the interest rates come down or something happens that you're ready to do it, you're ready to buy, you're going to need a great real estate agent. We can help you with that. Reach out to me. I have a great agent network. You can find them on saxrealty.com. You can go to click on the map. We're adding agents that we vet out, that we know have high, reviews, that, have been in the industry, that are full-time, right? That's a big thing. You need to make sure they're full-time. I know this is going to upset a lot of agents out there that are listening to this. They're not going to want to hear it, but I'm telling you, this is what you need. You need full-time agents. You need them to have great reviews, and you need them to at least be selling a half a dozen to a dozen houses right now in this time of year, right? And this climate, because if they're not going through it and seeing what's happening, and last time they sold a house was last year, they don't understand the real estate market. So guys, I'm talking to you buyers out there, get ready, get your agents in order, start interviewing. If you need help, reach out to me, send me an email. Joe can pull up, there we go, my email address right there. But guys, look, I want you to make sure that we're not falling into this, because this is what's going to happen again. They're going to drop interest rates, maybe. There's going to be more inventory out there, and we're going to go right back into the same madness potentially if you don't control your emotions, you don't control your FOMO, you don't control your decision making. Start asking your friends right now that bought houses how happy they are if they bought a house in 21, 22 with buying it without inspections. How much money have they put into the house since then? Do they think they could sell the house for what they have in it? And I'm going to tell you the answer is probably no. Mm-hmm. So, let's not fall into the same, traps that we did before. Let's be smarter, and we can do it together.
Yeah.
Right. We can work through it.
Yeah. I mean, there are big changes coming. You do need to be prepared. That's, part of our job here is to inform, educate, make sure everyone's going to be making those good decisions. But you're 100% right with the people that just bought in the past 2 years and how they possibly purchased. And there's a lot of unhappy people, and we don't need that anymore.
I have a client that just called me, and his wife is getting transferred to, I think, California. And they bought their house 2 years ago, mm-hmm. and they're in a brand new home community. Mm-hmm. And you know who I'm talking about.
I do.
And the concern is, hey, are these builders now offering incentives on new builds that will make it hard for them to come out of what they paid
right
at the height of the market?
Yep.
It's a big concern. 2 years, you don't have a lot of equity. You need about 10% equity. Maryland is very high, transfer recordation fees. My gosh, Montgomery County, if you bought a house or buying a house or selling a house over $600,000, they just doubled their transfer recordation fees. Montgomery County, right outside of DC. So, the government is, stepping up and I mean, they want, it's a money grab. In my opinion, it's a money grab. Mm-hmm. Anyway, let's take a couple more questions before we call it a night. Guys, what a great show. We love you so much for following our channel. If you haven't subscribed, we really appreciate it. It's one of the ways that you can let us know that we're doing a good job for you, subscribing to our channel. Hit that alert bell. You'll know when we upload content. Like I said before, if you jumped on here late and you didn't see Melody, check her out. Her channel's in the show notes. She's really starting to open up a little bit. Melody's been behind the scenes. So, she has a lot of experience. She's been behind the scenes. She's boots on the ground. Mm-hmm. She's trying to pick up her game. She's doing Twitter now. And guys, by the way, we're on Instagram and TikTok. You want to patronize us.
And I know a lot of you are new to our show tonight too. So thank you for being here. Thank you for participating, and thank you for commenting. And it's hard to get to all of these comments and questions this evening. We're very active, So, but we're very grateful for you.
Yeah. All right. Let's take a couple more questions before
Okay.
we sign off.
Yep, sounds great. I work at a small local credit union. VP just communicated to the credit union last week that they are going to start layoffs in the next couple of weeks. So many jobs open, but yet no one calls back.
I think a lot of the job openings are not real. I mean, I think there's a lot of job postings out there, and yeah. I mean, either that or they have thousands of people applying and they can't keep up with it. But I mean, anywhere you go, they're understaffed.
Yes.
So if they're hiring, you'd think that we'd see more people. I think the fact is, you know, and let's pull that up real quick, Joe. We have some bankruptcy stats. Not that we want to talk about bankruptcies, but, you know, bankruptcies are up. So if we look at, where are we? Bankruptcy filings, business and non-business filings, 2023. So we can see over 2022, businesses are up. So our non-business and total year over year since the major printing of money, we're starting to see, despite PPP. By the way, I didn't get any PPP. A lot of people ask me that. Well, did you get your PPP? No, I did not. Did not apply for it. But I think they found out that there was a lot of fraud in that too. I think they're going after companies now, which they should, for people that took that money.
Yeah, I mean, it was out of control, the whole thing.
So, you know, from what I understand, Chapter 7, and you guys can correct me in the comments, Chapter 7s are total time wipe out, you know, everything, both personal and corporate, though that is looking like it's around the same as last year. As we get into our reorganizations, I think Chapter 11 maybe is, I don't know, reorganization, Chapter 13 reorganization, but you can see they're up.
Mm-hmm.
And I mean, there's all kinds of ways. I had an attorney tell me today that with these bankruptcies, that there's all kinds of exceptions and sort of games that can be played in these bankruptcies, but they're up. I think that's the big thing. And the Wall Street Journal published an article, said small business bankruptcies rising at worst pace since the pandemic. And you think about it, the pandemic was pretty daggone bad, right? I mean, that was horrible.
Yeah.
I mean, people were shut down. People were locked in their homes. They weren't patronizing businesses. And that's one of the reasons why they had to jump in, right? The government, because we were in a major lockdown and it would have been a lot worse. I mean, I get it. I understand that we needed to, you know, provide assistance. I'm not totally ignorant to it, but I think it wasn't, I think it was taken advantage of by many. But small business bankruptcy filings are rising this year, a signal that increased interest rates. A signal that increased interest rates, tighter lending standards, and higher operating costs are straining entrepreneurs. At the same time, some government aid programs that helped entrepreneurs through the COVID-19 pandemic have ended. The Federal Reserve's efforts to slow inflation by raising interest rates, crazy idea, have been particularly painful for small businesses, which tend to operate with thinner profit margins and smaller cash reserves. We don't have to go on and read any more of it, but nearly 1,500 small businesses filed for Subchapter 5 bankruptcy this year through September 28, nearly as many as in all 2022. So I think that's kind of shows us where, you know, that's another thing that I say is like, how do we pay for houses when businesses are struggling and they're not going to be able to give raises?
Yep. I mean, you got another.
I heard another economist today said that we should have guaranteed jobs. That the government should. I mean, we got all kinds of podcasts coming up. This is going to be.
I mean, there's a lot to talk
There's
about.
a lot to talk about. We're going to have some interesting shows for you guys. I can tell you that we put Danielle DiMartino Booth on the books.
It's very exciting.
Right? She was at the Dallas Fed for 9 years. She wrote a book called Fed Up. She has been everywhere, all around, in all kinds of mainstream media, talking about what she believes is really going to happen. And so I'm excited to bring her on the show. what is that? October 26th. We podcast with her.
Yep.
So that will be that week that
Yeah.
we will release that. So really excited about that.
Very excited. Yeah, lots of good stuff going on. But I do want to say a couple more here. 15 million vacant homes and baby boomer homes are going to unleash a sea change of inventory in the decades ahead. We do not have a housing shortage in America.
We don't have one now.
Right.
I mean, this is, thanks for this comment. I mean, it's so true. And that's what people are saying. We've been saying that there hasn't been a housing shortage since
Yes.
last year,
Yep.
since April of last year.
Mm-hmm. Yep.
What we had was a controlled market.
That's
We
correct.
had supply chain issues, right? Plenty of inventory coming out of the ground. When we see the glut of multifamily housing that hits the market, we're at a 50-year high. Multifamily housing. When we see the amount of rentals that all these investors dove into, that have operators that said, hey, we're going to build in this city, we're building in Nashville, we're building in wherever, right? This high-end $2,000, $2,500 a month apartment inventory with lots of luxury that people are just going to say no to because they can't afford it. It's going
Yeah.
to be crazy.
People are saying no.
They are saying no.
Yep.
All right, let's take one more and then we'll wrap it up.
Okay. So this company overextended in expansion in the past year, doubled employee teams, and now getting laid off because they can't be profitable with the higher rates.
We haven't even seen AI take a hold of things yet. So, yeah, it's crazy. Any
Yeah.
super
I think
chat that we missed? We're
but
good?
let me just scroll through really
Sure.
quick. I think we,
Guys,
oh,
we
actually,
really appreciate you.
Yep.
We
I
got-
just want to, I just want to touch on them really quick because they're important. We really appreciate the super cash. If people have been taking out HELOCs to pay bills after maxing out their credit cards, what comes first? Missing house payments or HELOC payments?
Well, I mean, I don't believe that the HELOC is going to be able to foreclose on you without your first position, foreclosing and working something out. I mean, don't take me for, don't take what I just said as gospel because I don't know. But the way that it was before, so can a second position who's not the government, because certainly property taxes, their first position always. And that's why the servicer of your mortgage is escrowing payments to pay your property tax, because the government can come in and take that house regardless of who has a mortgage on it. So they take first position always. I don't know whether the HELOCs can force a foreclosure. Maybe they can. That's a great question. Back in the day, when the first was foreclosing, they couldn't foreclose unless they had the second, or, the HELOC in this case. They couldn't foreclose unless they got them to basically write it off or take a lesser amount of money, get on board with them so that they could foreclose the property. And that's one of the things that slowed down the foreclosure process, because so many people had second mortgages. They took out second mortgages to buy other properties, no different than what is happening right now. I know people that took home equity lines of credit to buy a second home. And now that is a variable rate that shot up on them and has burned them.
Yeah.
They're stuck.
They're
Anyway.
stuck.
All right, guys. Well, thank you so much. We appreciate you. We'll see you next time.
We'll see you next time.